Welcome back. The economic outlook has improved a bit, but it's perhaps not nearly as positive as the market seems to be. Steve Leisman is here with more on that. Hey, Steve.
Hey, Mike. Yeah, an interesting contradiction. Most forecasters still see tariff effects weakening growth and driving inflation higher, though somewhat less and later than they did in our last look. The average 15 forecast in the CNBC Rapid Update is up almost a percentage point for the second quarter for GDP to 2.5% from 1.6 in April. That's good, but you can see growth is still seen weaker in the third and fourth quarters before returning back towards a trend line beginning of 2026. Average core PCE inflation also came down for the second quarter with what looks to be an expectation of a delayed tariff impact, but it's forecast to shoot back up in the third and fourth quarter towards 3% again before coming back down next year. That remains a percentage point above the Fed's target and fuels the debate about whether the Fed should cut now or wait. In Fed Speak today, Chicago Fed President Austin Goolsbee said he worries about the possibility of both higher inflation and weaker growth, but that inflation and employment are both relatively low right now. Atlanta's Raphael Bostic, he's sticking to his forecast of just a single cut this year with 3 possible for next year. So the economic forecasts have changed only a bit while the market has surged. One part of that bet looks to be the idea that whatever price increases come from tariffs end up being a one-time event. And of course, Mike, this is exactly what the Fed chair is talking about, that most forecasters see inflation going up. So we checked and it is true.
Yeah, I guess that's how it works its way through their models, Steve. It can't not show up somewhere. Appreciate that. Let's bring in former Dallas Fed President Richard Fisher. Richard, also Jefferies senior advisor and a CNBC contributor. And it's good to have you here, Richard.
Well, if Steve says something, it is true. I just want you to know that.
All right. Well, I guess we're done here. No, so I do have I think it's really fascinating, this moment that we're in. A lot of assumptions have to kind of be pulled into service to figure out what the proper stance is. Now, part of what Chair Powell has been saying is that the committee does not believe that the cost of waiting and seeing is particularly high right now. Does that make sense to you?
I think it does from an economic and monetary standpoint. Obviously, the President of the United States is not happy with it. And so it creates a little anguish on that front. And frankly, it has no impact on monetary policy whatsoever. They'll do what they think is right. And right now, I just ask you to consider, as with all businesses in America, until we get clarity, and we're getting a little bit more, but until we have clarity in terms of tariffs and other actions on the economy, the bill that's hopefully about to be passed, you can't make a decision. You can't input the variables needed to model out the economy, which the Fed needs to do. So just like other businesses, they're sort of stymied here. They'd like to get more clarity, better understanding. And in the meantime, they're pausing. And I can understand that. I would be advocating for it as well.
Yeah, I mean, and obviously the president just today has kind of reiterated his stance that that Chair Powell is too late in making the United States pay more in interest payments and all the rest of it. But it's interesting how it's all playing out, isn't it, though? One, we know that Powell's not going to be renominated, so he realizes he's got like 10, 11 months left in the job. Right. The Supreme Court has said he can't be fired. So what we have is what we have. And therefore, you would think, especially given the committee as it's leaning right now, that they will just kind of call it as they see it for the next couple of meetings. Meantime, who knows? Maybe the data start to converge around the Fed doing exactly what the president is hoping it does.
Well, again, they're data driven. And until they get a better feeling for what the data are likely to be like or where they're leading us, I doubt they're going to move. Now, I just like to remind people, and Steve knows this as well as I do, this is not the first president to take on the Federal Reserve. He does it in a different manner, rather obtuse, very publicly. Again, don't forget what LBJ did to Chairman Martin. Mm-hmm. And also, before that, or after that, rather, what Ronald Reagan tried to do to Paul Volcker. He tried to get him impeached. They didn't talk about it like this president does that openly. And I like to say Donald Trump's approach is actually milder than LBJ's was with Chairman Martin. He took him to his ranch. He beat him up physically, literally slammed him against the wall. Mm-hmm. the boys are dying in Vietnam. You're not going to accommodate us on monetary policy. Martin did, and he wrote in his memoirs, he went to his deathbed ashamed of himself. Jay Powell's not going to do that. No one on the committee wants to do that. So let's keep this in perspective here. This is not unusual. It's over the top, the way this president likes to do things. That's his mannerism. He gets things done that way. It's not going to affect monetary policy. And
what about looking into next year,
et cetera? No, that's
and in terms of who the replacement to Powell might be, and whether that would change the formula.
Well, I'm of the view that unless it is Scott Bessent, who's outstanding, and every time he speaks, he's getting better and better. He's in control of the Treasury. I'm glad he's there. And on CNBC on Friday, he said we're in favor of a stronger dollar. That was a happy thing to hear because the president, vice president talked about a weaker dollar. But other than him, anybody else who might be named early, I like to say will have a stamp on their forehead that says Arthur Burns. Remember, what happened after Martin, Arthur Burns took over the Fed. He led to the greatest inflation because he accommodated two presidents and just gave in to them. So I think there's a real risk here. Anybody who is qualified here, Scott or anybody else, especially the others that don't have business credibility, if they're named early, they're going to be known as the new Arthur Burns. I don't think anybody who wants that job would want that nomenclature. And I don't think it'd be good for the markets either. So we have a lot of history here. I think people should be aware of it. And we'll just have to see what happens. But in the meantime, it's not going to impact monetary policy. Powell will conduct the committee, and the committee will go as they see is proper for the sake of the economy.
All right, we can rest assured in that at least. Richard, thanks so much. Appreciate it.
Well, if we name Leisman, that's another story to run the Fed. I'd be all in favor of it.
Gotcha.
All right. Thanks for having me.
Up next,
bye-bye.
Morgan Stanley's Mike Wilson standing by with his take on the rally and how much longer market strength can really last. We got the S&P up about 0.5%, helped by that pop in Apple. Closing bell. Be right back.
tradingview.com.
Welcome back. We are green across the board with both the S&P and the Nasdaq notching fresh all-time highs to close out the final trading day of the month and the quarter and the first half. My next guest is bullish on equities for the remainder of the year. Joining me now is Mike Wilson, Morgan Stanley's chief U.S. equity strategist and CIO. Mike, great to have you with me here. It's a fascinating round trip we've had, right, since early, I guess since February in a sense. Where does the market sit in your mind relative to all the kind of important drivers, right? I mean, we had this tariff policy scare and then a little bit of relief off of that. But in terms of the fundamental picture, technicals, demand for stocks, and all the rest of it.
Yeah, good afternoon, Mike. I would say, I mean, the tariff scare was sort of the final piece of what had been a correction that started almost a year ago. I think you've had some guests on today even talking about, like semiconductors, for example. I mean, they had a horrible second half of the year, as did many other groups. And I always like to say that markets sort of bottom on bad news. They also top on good news. And we basically had a lot of bad news through the end of last year and the first quarter that people didn't acknowledge. Most notably, just all the policy headwinds we had on immigration enforcement. We had DOGE, which was supposed to cut a bunch of spending, not very growth positive, and of course tariffs. We also had, AI CapEx deceleration and the DeepSeek announcement. So we just combined a lot of information into a short period of time, and the Fed, of course, has been on hold. And I kind of view Liberation Day more as capitulation day, and we sort of cleaned out a lot of things. Now, throw on top of all of that the sequencing of the policy going kind of growth negative, and now we're looking at some of the growth positive policy changes. For example, the tax incentives in this bill, deregulation, some of the things we're talking about doing with capital controls. That's what we have to look forward to, and that's what the market has gotten ahead of. And the one variable, I think, as you know, Mike, we've talked about this many times, the most important variable for stocks is earnings, and most importantly, earnings revision and earnings revision breadth. And if you looked at a chart of earnings revision breadth, which we published in today's note, it's a V-shaped recovery, and it's powerful as we've seen since COVID. So the expectations just got too low, and so it's not irrational at all for stocks to also show a V-shaped recovery here since April.
Yeah, in fact, we're showing that chart right now, and it is pretty stark. Also, though, I would note that it was a pretty similar trajectory, into the spring of 2023. We're up at about the same level. We bottomed around the same point in terms of earnings revision breadth. What's different now versus then when I think you weren't so pleased with the risk reward for stocks?
Well, back in 2023, what I would say the difference then was it was extremely narrow. Now, it's still a little bit narrow, but nothing like 2023. 2023 was coming off of what was a very sharp earnings recession in 22, particularly in technology shares and some of the consumer names payback from COVID. And the Fed, they were still sort of in hike mode. They weren't even close to thinking about cutting rates. So that's different this time. We think this is going to be a broader recovery. We've gone through a massive, so I would call rolling recession. And I think with the Fed cutting in the second half of this year or next year, we could see a rolling recovery because now there's quite a bit of pent-up demand, particularly in those interest rate sensitive parts of the market.
So where are we rolling into next, I guess, is the question. I mean, you could sort of observe just from a top-down level, okay, we're back up to 22 times forward earnings on the S&P 500. Obviously, you can slice and dice it and come up with something lower for the typical stock. But in terms of this technology, large cap growth bias that the market has had for a while, is that changing? Are we finally going to broaden out?
I think we're going to see those stocks continue to do well. They have tremendous earnings power. But what can broaden out is financials, some of the industrial space, which I think Chris was talking about earlier in the show, and then even some of the mid and small cap companies once the Fed starts cutting interest rates. Well, I'll go back again to interest rate sensitive parts of the market. I could name 6 or 7 different areas that have been in a recession for the most part for the last 2 years, whether it's manufacturing, housing related, autos, consumer goods, and all of those are very interest rate sensitive. So I think those parts of the economy is what we're looking forward to for 2026. And then, of course, AI, right? So AI, we spent all the money on CapEx, but now what we have to look forward to is the application layer. That's why a lot of these software stocks are doing better. And sort of the diffusion of that technology into the broader economy. I think that's what the market is getting excited about now. That's why multiples are high. They're saying the earnings power potentially could be higher than anybody's expecting next year because of margin expansion from AI efficiencies. And I think that's something to think about as the market broadens out next year.
In order for all those positive factors to really take hold, what do you have to assume about where the tariff rates and kind of the breadth of the tariff protection settle out?
Yeah, I mean, we've had a view for quite a while. We've always viewed this as sort of an import tax, a VAT tax, a consumption tax. And I think what they're driving towards is sort of a 10% VAT is essentially the way I think about it. It's a consumption tax, and it's a tax, okay, no doubt about it. But it's shared amongst importers, exporters, and consumers. Consumers will not eat all of that, and I don't think there's a ton of pricing power. But if we can kind of get to that point sooner rather than later, the market will look forward because companies can mitigate that. Companies can manage that. What they can't manage is the back and forth, 30, 40, 50% tariffs, and then how am I going to get my supply chains reordered? But if we can kind of settle on that 10% number, which is a big revenue generator, by the way, that's $300 to $400 billion a year, that's a good place. And I think there's a decent chance by the second half of the year we could get there.
Yeah, I mean, arguably that's what the market was essentially pricing in before we got the Liberation Day, details out. So might circle right back to that. Mike, thanks very much. Really appreciate it.
Great to see you.
All right, take care. Up next, we are tracking the biggest movers as we head into the close. Pippa standing by with those.
Well, solar stocks are split following the latest version of the tax bill. We've got the details on the winners and losers coming up next.
Coming up on 60 Minutes to the closing bell, the S&P 500 reached 6,200 for the first time. Let's get back to Pippa for a look at the key stocks to watch.
Hey, Mike, solar stocks are split on the Senate's markup of the tax bill. Residential installer Sunrun is surging since leased systems would once again qualify for credits. First Solar is also higher amid favorable credits for domestic manufacturers. But on the flip side, developers like AES, NextAir, and Clearway in the red, thanks to stricter timelines for projects to qualify for the incentives. Meantime, Hewlett-Packard Enterprise is leading the S&P by a sizable margin after the DOJ gave the green light for the proposed $14 billion acquisition of Juniper Networks. Juniper is also jumping on the announcement, hitting its highest level since 2011 with shares up some 8.5%. Mike?
All right. Yeah, I guess there was some doubt in the market about whether that was going to be approved. Thank you, Pippa. Still ahead, Ed Clissold of Ned Davis Research is standing by to break down the final moments of the trading day. Closing bell. We'll be right back.
Com.
A quick programming note, don't miss an exclusive sit-down with Amazon CEO Andy Jassy. That is tonight at 6 p.m. Eastern Time on Mad Money. Coming up on Closing Bell, Coinbase having a massive run this month. We will tell you what is behind that big move. The Market Zone is next. p.m. Eastern Time on We are now in the Closing Bell Market Zone. Kate Rogers is watching two big stock moves in the fast casual space. Tanea McKeel is looking at Coinbase's huge run, and Ned Davis Research's chief U.S. strategist Ed Clissold is helping us count down into the close as the S&P goes further into record territory, up almost 2/3 of 1%. We'll start with you, Kate, in these two restaurant moves.
Hey, Mike. Yeah, so two of the restaurant sector's hardest hit names for the year are rallying today. Cava up around 8% on the day. It has had a good June so far, up around 3.5%, but down 25% year to date. In the last 2 weeks, Stifel encouraging investors to take advantage of its recent dip as it laps some tough comps from last year's steak launch that happened over the summer. And also Sweetgreen following a similar pattern in today's trade, up around 10% today, 11% in June, down over 50% though year to date so far. Now, these names were very popular, remember, with investors last year. They've taken a hit even more so than fast food, though, lately, as consumers continue to be very discerning with their spending in this environment. Casual dining names, oddly, have performed better than others, being seen as more bang for your buck in this economy, Mike. Very interesting trend.
All right. It certainly is. Those were two stocks also kind of heavily shorted, and some of those stocks have been flying recently, too. Kate, thank you very much. Tanea, Coinbase, bring us up to date.
Yeah, Mike, up more than 40% in June for its best month since November. Third monthly gain in a row and first 3-month rally since 2023. Not just the best performing S&P stock this month, it's also the only S&P stock to double quarter to date. Some clear themes driving the gains, including the Senate's passage of the Genius Act and Circle's successful IPO. Also, of course, its very inclusion in the S&P 500 in late May, so quite the debut here. This is also happening, Mike, as investor attention shifts away from trading, Coinbase's core business, to non-trading uses of crypto, so particularly stablecoins. Trading volume on Coinbase trending lower in Q2. That's usually viewed as a risk, but analysts say shares have lots of room to run here, putting that largely on Coinbase's close tie to Circle's stablecoin revenue, which the market is still connecting the dots on. Mike?
Yes, certainly a lot of work trying to connect the dots there today. Thank you very much. Ed, we now have a market that, is kind of completed whatever we're going to call what happened in the spring, that severe correction. In fact, one of the fastest rebounds from a 15% plus pullback in the S&P 500 we've seen. What does that tell us? And I guess what does the overall market behavior suggest to you?
Yeah, Mike, it certainly has been risk on since the April lows. We went through a retesting period for a couple of weeks, but then once we got into late April, it's been very much risk on. You look at low quality stocks versus high quality stocks. They've outperformed non-dividend paying stocks, which tend to be high beta, have outperformed dividend paying stocks. The one area that usually is early cycle that hasn't participated as much are small caps, the Russell 2000, the Russell 1000. Roughly in line with each other. And so what's picked up the slack has been the mega cap growth stocks. Those were hit so hard during the correction, they've bounced back and then some. That's why you've seen the NASDAQ make a record high as well as the S&P. So this kind of behavior, again, with the exception of small caps, is generally consistent with the market trying to move higher and probably can make some further new highs in the second half of the year. Of course, there's always some more work to be done, more things to keep an eye on. But overall, the market is telling us it wants to move higher.
Yeah, I mean, I guess you can probably view that in multiple different ways in terms of, some of the aggressive post-IPO stock moves and things like that. It's interesting, though. It depends on where your starting point is. I've been pointing out that since the February peak, the previous peak in the S&P 500, earnings forecasts are higher, yields are lower, oil prices lower, the dollar lower. So it feels like it's a kind of accommodating backdrop. On the other hand, if you go back to the beginning of the year relative to what we expected then, maybe it's not as positive. So what does it tell us about the second half outlook?
Yeah, so let's go back to December when everybody was making their forecasts for the year. And versus then, I think GDP growth expected to be a little bit slower, earnings growth expected to be a little bit lower, and inflation expected to be a little bit higher. Now, there's room for the market to, I want to say, thread the needle because it's not that narrow of a path forward. There's a path forward for the market to move higher, but probably not quite as positive as it was at the beginning of the year. And there's room for upside surprises here, in particularly if the Fed goes ahead and cuts rates. When there's been long pauses in between Fed cuts, longer than 6 months, the market's done really well. So 3 months before and 3 months after, which would basically coincide with a September rate cut, the S&P's risen an average of 14%. So that's a potential upside surprise for the market in the second half.
Interesting. Yeah. And I know you've, I guess one of the debate points out there is the market's valuation. Now, typically you'd say elevated valuation means forward returns maybe are going to be lower than you would normally expect. Well, if I go back 5 years, the S&P was trading pretty much at 22, 23 times earnings. You've had a pretty decent 5-year return. So how do we reconcile these things?
Well, valuations just frankly aren't a great timing tool. They tell you where the risks are, and when the next hiccup comes for the market, these valuations probably mean that the decline will be larger than it would have been otherwise. I think that's part of the reason why you got a nearly 20% decline in just a few weeks earlier in the year. And what we want to look at here is what the tariff impact is going to be. We did some back of the envelope analysis of that. Could take about 50 basis points off of earnings. That's probably not enough to be a problem. But if it winds up being bigger than that, that's when the high valuations could come home to roost.
And in terms of what has been leadership in this market, what are the relevant characteristics of that leadership at this point? And do we expect, as long as this move continues, that that will remain consistent?
Well, so far it's been early phase type of behavior with low quality stocks and non-dividend payers and the high-flying growth stocks doing well. As we move forward, I think we need to look at what happens with inflation. If it becomes more traditional cyclical, you could see cyclical value sectors start to do better, like industrial will have already done pretty well, but you could see energy materials catch up, and financials, which have started to act better as well, could participate too. So that's where the inflation comes into play, as long as it's not so much that it causes a major correction in the market. So maybe rotation from the cyclical growth into the cyclical value part of the market.
Got it. We certainly will watch out for all that, Ed. Really appreciate you running through it with us today. As we head into the close, about 25 seconds left, we are going to be well into further record territory. The S&P 500 up more than 0.5%, now surmounting the 6,200 level. You see the Dow actually outperforming by a little bit. Apple, part of the Dow and the S&P, is a big part of that, up 2% on some late-breaking headlines on its AI initiatives. That does it for Closing Bell. Now let's turn it into Overtime with Morgan Brennan.
Well, that's the end of regulation. NERI, the Association for Investor Relations, ringing the closing bell at the New York Stock Exchange, as well as doing the honors at the NASDAQ. Well, stocks ending the day with the S&P and NASDAQ closing at record highs again. That's as financials and communication services led the gains 2 days in a row now of record closes. The Dow still about 2% from its last all-time high. For the month, the Dow rallied more than 4%, the S&P 5%, and the NASDAQ more than 6%. Today is also the end of the quarter, with the S&P posting its best quarter since December of 2023. It's also the end of the first half, and Treasuries posted their best first half stretch in 5 years. In terms of today, Oracle jumping after saying that it signed multiple large cloud services agreements. Robinhood hitting an all-time high as it announces an array of new crypto-related offerings. Meta also hitting an all-time high as investors continue to be bullish on its AI ambitions and all of those hires we've been hearing about. Hewlett-Packard and Juniper Networks both rallying after the DOJ settled its lawsuit challenging Hewlett's $14 billion acquisition of Juniper. Clean energy stocks, though, like Enphase Energy, falling after the latest version of the mega bill will phase out tax credits for the large-scale wind and solar projects that we've seen earlier than in previous drafts. And financials higher today after all 22 banks passed the Fed's annual stress test. The financials ETF, the XLF, hitting an all-time high in today's trading session. That is the scorecard on Wall Street. We just went through quite a lot, didn't we? Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. Well, that bell ends one of the wildest first halves of the year in market history. With a decline of 15%, a rebound to new highs for the S&P 500. Literally, we've watched history. You've traded history. Our market panel will tell us what to expect in the second half, and we'll talk to the head of one of the quarter's biggest gainers, Rocket Lab, which has doubled since the start of April. The CEO is going to join us. That's coming up. Plus, Ralph Schlosstein, co-founder of BlackRock. We're going to get his take on global markets and M&A activity. He's over at Evercore now. But let's begin with the markets. The close to the second quarter for the NASDAQ. It's the best quarter in 5 years. Mike Santoli joining us from the New York Stock Exchange to break it down. Hi, Mike.
Hi, Morgan. You know, you mentioned all these extraordinary things, and it's landed us in a place that actually seems somewhat normal and expected. The S&P 500 up between 5 and 6% for half the year. It's about half the annual average return. Also, if you remember coming into this year, there was a line that said, oh, you know, after you get two 20% up years in a row, you should expect some downside volatility. First half of a post-presidential election year, third year of a bull market, all often have a little bit of payback associated with them. All that being being said, nobody thought we'd get what we got, which is a V bottom around the tariff panic in early April. And what I think is interesting is you've reasserted the AI leadership. The revival of that story has really been consistent, and now it's only more so. And alongside it, we've almost gone through a psychology cycle with regard to viewing how the economy is performing. I do wonder if the data are going to back that up, but now we're in a sense of feeling as if, or at least the market pricing in, the Fed easing within the next few months into a decent economy. That's kind of the best backdrop for stocks.
What's incredible to me, Mike, is the fact that all of the major averages, with the exception of the Russell 2000 and the Dow Transports, which tend to be smaller stocks and are still under pressure now here since the beginning of the year, the NASDAQ, the S&P, Dow Industrials, NASDAQ 100, they're all higher on the year. That's coming after 2 straight years of double-digit % gains. We came into this year having the conversation that it was going to be very hard for markets to break out in the same sort of meaningful way after 2 strong years of gains. So how does this set us up for the back half?
Well, that was all true, and in a way, it's kind of come to pass in terms of it being a little bit of a struggle. I think you could point to the fact that, you're still, if you look below the surface of the index, it's still coming along in that direction, but definitely the average stock is still like 10% below its high or more. So it's still more catch up to be done as part of that process. I think in general, look, you don't necessarily reflexively fade a new high. Usually, it shows you the market has been somewhat stress tested and better forward implications of that new high. That's over the multiple months. Honestly, you can start to say this market's going to start to look overbought. It's going to need a rest. You have some exhaustion signals that I look at sometimes in terms of the technicals, but that shouldn't change the overall path. In mid-May, we already had an overbought market, and all that happened was you kind of eased back by a few percent and went flat for a few weeks, and that took care of that.
Okay. Mike Santoli, we'll see you throughout the hour. Thank you. From Wall Street to Washington, as the Senate begins what's being called a vote-a-rama on the massive budget bill, Emily Wilkins is joining us now with the latest on that process. And it does seem to be shifting hour to hour here, Emily.
Morgan, yes. I mean, look, senators, they're continuing to work through dozens of amendments. They were expecting a final vote actually on the bill either very late tonight or very early tomorrow on whether or not that bill can pass. That is, of course, as long as they have the votes. Break down the math here. 2 Republicans voted against a procedural vote this weekend. That means if those 2 plan to vote against the bill, which they do, senators can only lose 1 more. And several senators, including fiscal hawks like Ron Johnson, and then more moderate-leaning members like Susan Collins, they haven't said yet how they are going to vote on the final bill. And part of the reason is that the bill could still change before it passes. There are a number of amendments being put forward by Republicans that are actually gaining some degree of support. So Senator Rick Scott, he's planning to offer an amendment on further federal Medicaid cuts that would shift a greater burden to the states. Another group of senators are seeking to reverse some changes that were made over the weekend to clean energy tax credits. So the changes would have limited the scope of the credits. The senators want to expand it again. And then Senators Marsha Blackburn and Ted Cruz reached an agreement over the weekend to change that ban on states implementing AI laws. So the new language they're putting forward would have the ban to just 5 years. It would also exempt state laws that seek to protect kids and content creators. So we're going to be keeping a very close eye on all of these amendments if and when they come to the floor, and if they wind up changing that final vote tally. And if the Senate does wind up passing it, it's still not in the clear yet. It's on to the House, and the House could potentially vote as soon as Wednesday. Of course, again, if they have the votes, because, Morgan, there's a lot of concern over there on some of the fiscal aspects of this bill.
This is just a heavy sprint that could potentially happen by the end of the week. And Emily Wilkins, you've got a front row seat. You're bringing us the latest, and we appreciate it. Emily Wilkins from Washington. She's there on the Capitol reporting all of this out in real time. Let's begin with the market. And what a strong quarter it's been on Wall Street. The Dow's up 4%. The S&P 500 soaring to 10%. The NASDAQ is higher by 17%, tracking for its best quarterly gain in 5 years. So technology, communication services, industrials, discretionary are among the top performing sectors on the S&P 500 quarter to date. And joining us now with key themes to watch in the second half is Richard Bernstein, Advisor CEO Richard Bernstein, and Citi U.S. equity strategist Scott Cronert. I mean, this is an all-star market panel to have this conversation. So welcome to you both, gentlemen. Richard, I'll kick it off with you. We're at record highs for the S&P and the NASDAQ. Stocks continue to climb the wall of worry. What's next?
So, Morgan, good afternoon. I think, stocks are looking at a situation where it looks like we're going to have pretty significant fiscal stimulus. And I think more than that, the markets are still banking on the Fed being able to cut rates. So if you've got positive fiscal policy and positive monetary policy, it's hard to see why stocks would go down. However, that being said, what's I think more confusing, and everybody should be kind of scratching their heads a little bit, is why, with all this broad policy in the economy, are we seeing such a narrow stock market? That doesn't seem to make an awful lot of sense. We should be seeing, if these policies are actually going to work, we should see a much broader stock market, meaning more companies are going to benefit from it.
Why do you think it is so narrow? And we talk about big cap, Richard, we talk about big cap dominance. Has that sort of reasserted itself? And if so, why? Why now?
So, Morgan, I would correct one thing. I don't think it's even large cap. I think it's about 10 or 15 or 20 companies. When you mentioned before the NASDAQ 100, the NASDAQ, the S&P, but not things like the Russell 2000 and the Dow Transports. It's the same 10 or 15 or 20 companies that are dominating the marketplace. I personally think that reflects the speculative fervor in the stock market. There are way more than 10 or 15 or 20 growth stories. It's just that nobody cares. They only want to trade, keyword trade, 10 or 15 or 20 companies. I think if you're an investor, it doesn't get much better than this because nobody cares about all these attractive investments as opposed to simple trading.
Scott, what do you think? You used the word euphoria in your note.
Yeah, Morgan, I think we're approaching euphoria in our classic sentiment indicators, but I take a couple of points of issue with Richard's comments. I think what we're looking at here is really a follow the growth mantra to this market. We walked to the edge of the cliff fundamentally with DeepSeek earlier in the year, and then the Liberation Day tariffs. And since then, we've been walking back from concerns on both. You've begun to see the AI tailwinds kick in, if not accelerate. But what's happening here is that the Mag 7 are showing a perpetual earnings growth dynamic into 2026, which is actually beginning to increase now from where it was. The other 493 searching for bottom still, but what we're seeing here is a very clear differentiation between those companies where there's an upward bias to numbers as we go into the back half of this year, begin to look ahead to 26, and we think that's going to be your ongoing driver here. So what we need in terms of the Fed discussion, the fiscal narrative, is that we need to see some sense of a soft landing continue to show through. But ultimately, we need to begin to see an earnings revision dynamic to the positive for that part of the market that's more traditionally interest rate sensitive.
And of course, we start to get earnings again in full throttle in about 2 weeks, give or take. So, Scott, where do you put money to work right now then, if this is how you see the next 6 months, year playing out here? How do you position yourself for the second half?
Well, we just put out our quarterly sector call over the weekend, and let's say that we went all in on growth going into Q2, and we're digging in on that call. We still like the tech sector. We like communication services, both media and the telecom component, interestingly. And then we're beginning to broaden beyond that. From a cyclical perspective, we've been on financials via the banks for the better part of a year. Still like that. And we're starting to allow, as I mentioned earlier, for some room for those areas of the market that have a bit more of an interest rate sensitive bias to it to kick in. We went overweight utilities as an example of that. So where we're going with this is that wherever the growth revisions are taking us, and we think that's going to be this AI and related construct, that's where we want to continue to focus for now.
Okay. Gentlemen, thank you for kicking off the hour with me. Scott Cronert and Richard Bernstein, with the S&P finishing at a new record, 6204. Well, we've got breaking news on Boeing, and Phil LeBeau has the details for us. Hi, Phil.
Morgan, we have a transition when it comes to CFO of Boeing. Jesus J. Malave, former CFO of Lockheed Martin, former CFO of L3 Harris, of UTC Aerospace. very experienced when it comes to being a chief financial officer. He will become the Boeing chief financial officer on August 15th. Brian West, who has been CFO over the last 4 years, who has steered the company through some really turbulent times in terms of capital raises and some challenges in terms of the balance sheet. He will now transition to a senior advisor role to Kelly Ortberg, CEO of Boeing. Again, new CFO, at Boeing. Jay Malave, starting on August 15th. Morgan, send it back to you.
All right. Jay Malave, former Lockheed, as you just mentioned, someone I've spoken to quite a bit over the years. Phil LeBeau, thank you. Apple, by far the worst performing Mag 7 stock in the second quarter. It's the only one that actually finished the quarter in the red. But today, Apple is the leader. Let's bring in Steve Kovac for more on the news that is pushing those shares higher.
Yeah, and it looked like for a second there it was going to lose that $3 trillion market cap again. But what happened today was Bloomberg reporting that Apple is considering third-party AI companies to partner with if it can't get its own version of Siri off the ground. Now, you might remember, Morgan, earlier this year, Apple gave that splashy delay of the AI upgrade to Siri. That was part of the reason the stock has been under pressure most of the year. Tariffs also play into it as well. But what Bloomberg is reporting there, Apple is looking at Anthropic and OpenAI as potential partners to kind of power this new version of Siri if they can't get their own large language model off the ground. In fact, the story specifically says Apple right now is leaning towards licensing Anthropic's technology. Now, we know that Apple or other companies have had success building on top of these two companies. Perplexity is the search engine company is the best example of this. They take Anthropic's technology and OpenAI's technology and put their own search layer on top of that. So we do know this is possible using that kind of technology for it, but it would also kind of be an admission that Apple is further behind than maybe even it thought it was, or at least has said publicly it is, when it comes to these big generative AI things. So we'll have to wait and see. Apple said right now that it's going to be 2026 when they get this out the door. This kind of gives them insurance. That's the way I'm looking at it. If they can't figure it out on their own, at least they have this kind of backup plan that they could go to and say, Anthropic will start paying you for your models until we can figure out on our own.
How common or unusual would it be to see a big player like Apple doing multiple partnerships, multiple deals, multiple licensing with competitors like this?
They kind of have to. And I mean, it's competitors, but also partners at the same time, right? And look at what all these other companies are doing. You have Meta today spending enormous amounts of money just to build this, what they're calling that super intelligence team. Apple, as we know, they're just kind of allergic to big acquisitions, big splashy hires, spending a lot of money on these kind of people and companies to bring them in order to build this stuff. So partnering would make sense. It would make less sense, at least historically, for Apple to go out there and buy a company like Anthropic. But licensing the technology, that is definitely on the table. The one problem here, though, Morgan, is the cloud stuff. Now, we know Apple loves all their privacy and talking about that. What this report is saying, they've figured out a way, or have at least talked about a way, to run those models on their own private cloud servers as opposed to what you have from Google or Microsoft or another thing. So that is another potential option here, but it does at least put them on a path, and that's why you see the shares up to get this shipped now on time, or at least the new time of 2026.
Okay, we'll be watching. Shares finishing up 2% today. We'll see if the catch-up trade continues.
Yeah,
Steve
exactly.
Kovac, thank you. Well, coming up, we're going to break down the latest from Washington. The Senate working on this budget bill as trade negotiations are moving forward with Canada and others ahead of the looming deadline there as well. And with the second quarter now in the books, we're going to look at some of the biggest winners over the past 3 months. There are quite a few. So stay with us. Overtime is back in 2. Welcome back to Overtime. The S&P with a 10% gain in the second quarter. Let's take a look at the biggest winners on the index. Coinbase, the leader. It more than doubled over the past 3 months. Energy names also big winners. GE Vernova, NRG, and Vistra all in the top 5. But let's turn back to Washington, because the spending bill getting all the attention as the Senate vote-a-rama is underway. But the Trump administration is also racing to finalize trade deals as that July 9th deadline looms next week. So joining us now is Brian Gardner. He's Stifel's Washington policy strategist. Brian, it's great to have you back on. First, going to start with one big, beautiful bill and the fact that we even have a daytime vote-a-rama in the Senate. How unusual is that?
We only get these every couple of years, so it's not a regular occurrence. But a vote-a-rama is part of the reconciliation process. So we have seen these before. There's also vote-a-ramas as part of the budget resolution, which is a precursor, which we had back in the winter. So these things happen from time to time. They're kind of entertaining to watch for policy wonks, but I don't think we'll see what impact it has on the overall bill when the voting's all finished and what gets added or what gets dropped.
Yeah. And of course, and I guess it's not the fact that we even have a vote-a-rama. It's the fact that there was a break and then they came back to have the vote-a-rama instead of dragging it through the wee hours of the evening. I know that was getting some attention earlier today.
They're just pushing to see if they can get this done, to get one big beautiful bill signed on one big beautiful holiday. And that's the ultimate goal here.
Can it happen? What are the sticking points?
I think the sticking point is still Medicaid. I think Emily was discussing this before. I mean, you have the conservatives, the budget hawks on one side who want more spending cuts related to Medicaid. You have moderates who are apprehensive about those cuts and may hold out. Both on the Senate and the House side, there are very narrow margins. My base case is this gets done by the holiday. I mean, I was skeptical until going into the weekend. But if you're a holdout, you're going to be asking yourself, what am I going to stick out for? What am I going to get? And do I want to put up with the wrath of President Trump if I vote against this? We see how he reacted to Tom Tillis over the weekend when Tillis voted against a procedural vote on Saturday. I think there are going to be a lot of Republicans who just don't want to go through that. And they may not like everything that's in the bill. They're going to be apprehensive about a lot of what's in the bill. And at the end of the day, they're going to vote for what's in the bill.
I mean, the bond market seems to be somewhat sanguine right now in terms of what this potentially will add from a debt load perspective. But is there a point at which that could change?
We have been talking kind of in doomsday scenarios for 40 years. People have been concerned about debt and deficits for a very long time, and it hasn't mattered. It's not going to matter until it matters. Are we at that tipping point? Are we at that catalyst moment? I kind of doubt it. I think that's further down the road when we get into closer to 2034, when the trust funds for Medicare and Social Security can't pay out all of their obligations, 100% of their obligations. I think that's when it really gets real. For now, I think the bond market feels comfortable enough about the short-term, medium-term economic outlook in the United States and its ability to service its debt. It gets more challenging in the next decade.
And of course, you have the offset of potentially spurring some economic growth in the middle class here, depending on how all this shakes out in the final details of this bill. Let's talk trade, shall we? We got this July 9th deadline, which may or may not shift for some countries. Treasury Secretary Scott Bessent joined me here on this show on Friday and basically said 10 to 12 possible deals waiting in the wings, another 20 that could get negotiated. You could potentially even see, that deadline slip for if they felt they were negotiating in good faith. That's a lot of potential countries coming to the table. How do you game it out?
I think we're going to see some extensions. I've always believed that. If we were having this conversation back in April when the pause was announced, I would have said, well, look, you have some very large, complex trading partners, trading arrangements, and rearranging those, restructuring those in 90 days is very difficult. And it's not just tariffs. I mean, people focus on the rate of tariffs, but there are non-trade barriers. Just to give you an example, some countries that block genetically modified foods from being imported into their country. That's a big sticking point for the United States. And so these are issues that are not easily resolved in 90 days. And so I think we're going to get a handful of deals over the next 10 days, and then we're going to see some pauses.
Okay. Anything on the deregulation front we should be watching as well as we move through some of these key dates here over the next couple weeks?
It's funny because the deregulation story takes place in the background, right? We're talking about the high profile, big headline stuff with trade and one big beautiful bill. But the whole time in the background has been the deregulatory story. We saw a little bit last week in financials with some changes to bank capital rules. I think we're going to see some loosening up of bank M&A. I think we're going to see an increase in bank M&A over the next couple of months. I think we're going to see more of it in energy. So there's a lot going on behind the scenes that it's tougher to talk about because it's not one moment. It's a process over a long time. But it is going on, and I think that is a positive for the markets.
Brian Gardner, thank you.
Thank you,
Coming
Morgan.
up, stocks with a record-setting rebound to end the second quarter. What can investors expect as we turn the corner to the second half of the year? And self-driving isn't just for robo-taxis. The U.S. Army is also working on autonomous vehicles as part of its big tech transformation. We're going to take a look at that next. Welcome back. We have a news alert on Circle, and Tanea McKeel has the details for us. Hi, Tanea.
Hey, Morgan. Yeah, stablecoin issuer Circle has applied for a national trust bank charter. That's a move that would allow it to custody its own reserves and hold assets for institutional clients. The new bank entity would be called First National Digital Currency Bank, which would be overseen by the Office of the Controller of the Currency. It would be the second crypto company to obtain such a license after Anchorage Digital. Shares little changed after hours, but the move does come after a wildly successful IPO, of course, for Circle and debut trading month on the public markets. Circle surged more than 480% in June, as well as a wave of optimism after the Senate's passage of the Genius Act, which would give the U.S. a regulatory framework for stablecoins. Circle also saying that having a federally regulated trust charter would help the company meet requirements under that proposed legislation. Lots to watch here. Morgan.
All right. Of course, the stock is jumping another 2.5% right now here in overtime. Tanea McKeel, thank you. It's time now for a CNBC News Update with Contessa Brewer. Hi, Contessa.
Hi there, Morgan. President Trump has just signed an executive order ending U.S. sanctions on Syria. The White House said that order still maintains sanctions on former President Bashar al-Assad and his associates. The country's transitional government has been pushing the White House for sanctions relief because, of course, it's trying to rebuild after a devastating civil war. Law enforcement officials say they've identified the suspect behind yesterday's deadly ambush of firefighters in Idaho. Authorities say 20-year-old Wes Rowley is suspected of intentionally setting the fire to allure the firefighters and then opened fire. 2 were fatally shot. A third was injured. Officials say they're still trying to identify the motive. And Kilmar Abrego Garcia will stay in a Tennessee jail for now. A federal judge today sided with Abrego Garcia's lawyers. They have asked for a delay in his release because they worry he could be deported if he's released before his trial on human smuggling charges. All right, Morgan, that's the news. I'll send it back to you.
Contessa Brewer, thank you. Coming up, I'll be joined by the co-founder of BlackRock. We will get his take on the markets right now and what he's seeing in the global economy in the second half of the year. Ralph Schlosstein is on set. He's coming up next.